Most beginner investors make investing far more complicated than it needs to be. They try to pick winning stocks. They follow headlines. They jump in and out of the market. But long-term wealth is usually built in a much simpler way. With just 3 funds. In this video, I'll break down the 3-fund portfolio, a strategy designed to grow wealth steadily without constant decisions, predictions, or stress. Why most beginners struggle when people first start investing. They feel pressure to outperform the market. They believe they need to find the next big stock. The problem? Even professional fund managers struggle to consistently beat the market over long periods of time. Individual companies can rise quickly, but they can also fall just as fast. And when your money is concentrated in just a few stocks, your risk increases dramatically. The 3-fund portfolio takes a different approach. Instead of trying to win by prediction, it wins through diversification. What is the 3-fund portfolio? The 3-fund portfolio is a simple investing framework built around 3 broad index funds. Each fund plays a specific role. Together, they create growth, diversification, and stability. The 3 parts are a total US market index fund, an international stock index fund, a bond index fund. Let's break each one down. Total US market index fund. This fund tracks the entire US stock market. That means instead of buying one company, you're buying thousands. Large companies, mid-sized companies, small companies. If the US economy grows over time, this fund grows with it. It's diversified. It's low cost. And historically, the US market has produced strong long-term returns. For most investors, this makes up the largest portion of the portfolio. International Index Fund. The second fund gives you exposure outside the United States. It includes companies in Europe, Asia, and emerging markets. Why does this matter? Because no single country dominates forever. If the US slows down, another region may be expanding. International exposure reduces country-specific risk and increases overall diversification. It protects you from putting all your eggs in one economy. Bond Index Fund. The third fund is a bond index fund. Bonds are generally less volatile than stocks. They don't grow as quickly, but they provide stability. When stock markets decline, bonds often decline less, and sometimes even rise. This reduces the overall swings in your portfolio. And smaller swings make it easier to stay invested during downturns. Example allocation. A simple example allocation might look like this. If you're in your 20s or 30s and focused on growth, 70% US market, 20% international, 10% bonds. If you're closer to retirement, you may increase bonds for stability. There's no perfect allocation. The key is balance, based on your time horizon and risk tolerance. Why this strategy works? The 3-fund portfolio works because it removes emotion. You're not guessing. You're not reacting to headlines. You're not chasing performance. You own the market. You keep costs low. You stay diversified. And over long periods of time, markets have historically trended upward. This strategy captures that growth without unnecessary complexity. How to set it up? Setting this up is straightforward. Step 1. Open a brokerage or retirement account. Step 2. Choose low-cost index funds that track the US market, international markets, and bonds. Step 3. Decide your percentage allocation. Step 4. Automate your contributions monthly. Automation removes emotion. Consistency builds wealth. Links to commonly used platforms are in the description if you'd like to explore your options. Mistakes to avoid. Even simple strategies can fail if discipline breaks down. Avoid constantly changing your allocation. Trying to time market crashes. chasing whatever performed best last year, ignoring expense ratios, panic selling during downturns. The strength of this portfolio comes from staying consistent. In conclusion, the 3-fund portfolio isn't exciting. It won't make headlines. But it is simple. It is diversified. And it is built for long-term growth. Wealth isn't built by constant action. It's built through structure and patience. If you want more clear, structured breakdowns of investing systems, subscribe for future videos. Because investing becomes much simpler when you follow a framework.